What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is December 21st of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to talk about the breaking point, a set of charts where if we do not hold certain key levels in price, I think we are set in for a major wave of capitulation. And it's not just analyzing crypto, but the broader equity markets and macro perspective as a whole. We've got a lot to dive into today's video, as well as a sponsored review of the updates that came out from the Radix RadFi event, which showcased some of the really exciting potential of this layer 1 network that we're keeping a sharp eye on during the bear market. So stay tuned. You guys won't want to miss it. And if you like the video, drop a like. So let's go ahead and kick off the rambling. So I want to start here with Bitcoin, because I think it's very important to understand why we've continued to remain generally bearish on Bitcoin, and talk about why we could expect another major capitulation wave. There are three big things here, two of which have to do with price, and one of them has to do with market order flow. The first one is obviously being well suspended below the 200-week moving averages as well as the 200-day moving averages. This alone is already a really big worrying sign. We're not even getting an opportunity to come up and retest that 200-day. Now that alone already still leaves us in a bearish position. But the fact that we are well suspended and not even coming up to retest those 200 days as well as the 200 week is a big worrying sign here. And when we just zoom out here, you can start to see what I mean here, as the 200 week usually was the buy the dip opportunity for Bitcoin. It is now acting as resistance alongside the cross of the 200-day below that 200 week. So this is already one big issue here. The second one as well is that the relief rallies that we're getting off of these new lows from the generally lower highs and lower lows that we've been formulating throughout 2022 have continued to get weaker and weaker, showcasing that bulls aren't showing up to the plate like they used to, and is further signs that we have a major capitulation wave to come, or at least we are at much higher suspended valuations than we should be. Now that's point number two. But point number three has to do with market order flow. Now, through our partner Bookmap, who we've had here on the channel for some time, which analyzes deep market data outside of just analyzing price action, such as its heat map tool to track bid and ask support, as well as the cumulative volume delta, which tracks market order flow, we can see that week by week, as we analyze it here on the channel, that market order flow week over week has been negative yet again. We have not seen any major deviation from this trend. This is why Bookmap is so valuable here, because it can start to showcase where the demand is to take the best available price. Are more people market buying or market selling at Bitcoin's current price? Right? Are people FOMOing in, or are they fearing that prices are going to go lower and taking the best available price to go back into cash? Well, we're seeing the latter right now. We're seeing people continue to sell at the moment and take the best available price, as the industry is going through its biggest restructuring since the Mt. Gox hack back in 2014 and 2015. So again, I really want to emphasize that when we're taking a look at the micro perspective, right, just taking a look at crypto, things are not looking that good. But if we step into the macro perspective, we can start to see that there are also some worrying charts both in traditional equities and in crypto. So let's go ahead and take a look at the biggest breaking point chart, right? Again, with Bitcoin, I want to emphasize our breaking point here, which is if we really break below the previous lows and this line of sloping resistance, if we can't hold this descending line of previous resistance, that is going to be a major worrying sign. Essentially speaking, if we see price, even if it comes up here towards the previous resistance range or previous support range at around 18,000, and we zigzag below here, breaking below those previous lows, that is your worrying sign for a major capitulation event. But next up, we got to look into the macro perspective. Take a look at Apple here. Now, we are not looking at the daily chart. We're not even looking at the weekly chart. And most certainly, we are not looking at the hourly or 5-minute chart. We're taking a look at the monthly chart right now. And I want you to take a look at this chart and tell me again, understanding that these blue lines here are the 200-day moving average, meaning it's the average price over the last 200 days up to that price point. And the orange and red line, which are the 200-week and 200-week exponential moving averages. Take a look at this chart here, right? And tell me if you think we've hit a bottom just yet. I'm going to go ahead and give you guys a couple of different perspectives on this chart here and talk about why I think this is such a big deal. But just take a look at the chart once more. Does this look strong to you, or does it look weak? Does it look like momentum is starting to stall? I gotta be honest with you guys. I feel it's the latter. I think we are starting to see serious signs that momentum is fading in one of the most secure and defensive plays in the technology sector that's led over this last decade during this previous secular bull market that I think we have come to an end on. It is very, very clear by the way price action has been acting for the past couple of months. Let's dive into the weekly, right? Let's get a little bit more kind of narrow our view here. You can start to see how each and every time we used to deviate below that 200-day, we would come up roaring back above it. But now, since the past couple of months, since back in October, each and every time we've come up multiple times towards that 200-day, it has been acting this clear resistance. We are not too far away from coming down to retest that 200-week, which already alone, if you're considering Apple's valuation, is hundreds of billions of dollars in lost market cap, which is definitely going to have a cascading or contagion effect on the broader equity markets, and for sure, it's going to also have an impact on very risk-on assets like crypto. But to make matters worse, I want to make the case that we may see a retest below that 200-week. Again, the 200-week served as a buy-the-dip opportunity during the secular bull market of the last decade. But what happens if we have a repeat of, say, the dot-com bubble or 2008? Where we actually go below that 200-week and potentially stay there for a long period of time. Now again, it's a bit difficult to look back through Apple's previous history when it was trading at a fraction of the market cap it was at now and try to draw direct comparisons. I'm not here to say that it's going to play exactly like it did in the past, but I do want to echo the point that when we see recessions versus those secular bull runs where usually what people may label as bear markets, those 15-20% dips in valuation, potentially on a specific stock like Apple, maybe 33%. The key point is that I think we're entering into a similar era to where we were in 2008 or the dot-com bubble. What does that mean for Apple, right? I mean, to put it in perspective, we've only seen Apple drop right now about 28 to 30% here if you're taking maybe the absolute low. Only a 30% decline in price, whereas Amazon has gone down around 55%. And I gotta be honest with you all, if you're taking a look back at history, Amazon during the dot-com bubble went down 95%. Now, even if we don't do, say, a 95% correction, again, don't want to draw direct comparisons, it's not too far off to think that some of these big stocks like Apple, Amazon, Netflix, Meta, Microsoft can easily take what they've already got, like for in the case of Amazon, a 55% correction, and drag it down to something like a 75% correction. The difference between that and, say, a 95% correction, which I'm not calling for here on Amazon, is much, much more different. So I think we're somewhere in this pocket here for these companies, well below their 200-week moving average, similar to what we saw back during that bear market, right? Where we had multiple relief rallies and therefore further moves lower on those technology plays. And it's also why, going back to crypto and kind of wrapping up the conversation here, again, we see Ethereum at highly suspended levels here. Another key level to watch is a break on that 200-day. If we see a break on ETH's 200-day against Bitcoin and the ETH to BTC ratio, I think you've got a 50% correction in the cards, because this takes us down, roughly speaking, into a range where the 200-week is anywhere down 35 to 45%. And the reason why we have the 50% mark here is because that's been the historic support range. That's where history's shown us that it's time to buy ETH against Bitcoin. That's still much higher than where we were during the last bear market. That would still be a really optimal level, more than twice the low valuation of the ETH to BTC ratio. So the question here you have to ask yourselves is, are we at the bottom just yet? Is it not even so much are we at the bottom, is it time to really start getting optimistic just yet? I think it's coming down the line here. Maybe not too far off, maybe in Q1 of 2023. But there is still a lot of contagion going on post-FTX. There are a lot of black boxes in the crypto space, a lack of transparency, uncertainty around Grayscale's GBTC product, uncertainty around Grayscale as a company as well as Digital Currency Group, its parent company. There's a lot of uncertainty about Crypto.com, Binance, all these major exchanges. And while I'm not here to spew unnecessary FUD, I'm going to go ahead and stick to the commitment here that the trend has been showcasing, which is that there's still things being unraveled. And I think, more than anything, putting aside all the conspiracies and rumors, I think a major restructuring of the crypto space. People rethinking what is valuable in crypto and which protocols are going to be able to actually build the next wave, similar to what we saw during the dot-com bubble, where there's a major restructuring and only the strongest, like companies like Amazon, survived, where a lot of companies filtered out. I want to go ahead and emphasize here that when you're focusing on investing in altcoins, you need to realize that the vast majority of them are going to go to zero. If we take the dot-com bubble as an example, which I think is very similar to what we're going through right now in regards to crypto, the dot-com bubble was the collapse of internet stocks back during the 90s and entering into the bear market in the early 2000s. I think we're going through that for crypto as an industry. But what are the 2% that are going to not only survive, but the 1% that are going to thrive and become market leaders in the next bull market? That's what I want to spend some time to talk about here in today's video as we cover our partner, our long-term partner for over a year plus here on the channel, Radix. So let's go ahead and dive into the recent exciting news events that came from the RadFi event just back a couple weeks ago. Alrighty everyone, so in today's review portion of the video, I'm going to be spending some time to dive into one of our favorite Layer 1 protocols and their recent exciting announcement, and that is no other than Radix DLT and the recent RadFi event that launched a little over a week ago that showcased some of the really exciting potential behind this new Layer 1 protocol. Now I gotta be honest with you guys, it's no fluff. This is really one of the most exciting Layer 1 protocols that I'm watching right now over the coming years in crypto that I think actually has the foundation to be able to serve as the largest Layer 1 to scale DeFi long term. Now, I'm not only going to be talking a little bit about what Radix is for those of you who maybe haven't heard me talk about it just yet, but on top of that, talk about two major takeaways from the recent RadFi event. The analogy that Pierce Ridyard made about building an engine for DeFi, and on top of that as well, talking about 5 of the major user experience components that on a protocol level make Radix so beneficial compared to other Layer 1s. We got a lot of things to dive into in today's video. Let's go ahead and start off with the basics here. Now, for those of you who haven't heard about Radix is, as it says on its website, aiming to radically differentiate DeFi. Now, DeFi over the past couple of years has really been in a bubble. It's been basically building applications that have essentially been in a circular environment where capital and actions are really just within this small niche sector that we call DeFi. But DeFi really hasn't stepped into the broader world. It hasn't started to touch us in our personal lives, within our personal finances, and potentially even serve as a disrupting force to the banking sector. That's where DeFi can really scale to trillions of dollars. But the problem is that all of DeFi, or at least the majority of it, is built on top of Ethereum, which doesn't have a high degree of scalability, and on top of that has tons of security vulnerabilities, and to make matters worse, is incredibly difficult for developers to build on. Radix is aiming to completely upend that traditional system of thinking, that we have to settle for the current user experience, that we have to settle for the current developer experience of building decentralized applications, and within a limited framework. Radix is aiming through its language Scripto and its scaling solution Cerberus to be able to build a network that will be able to scale to trillions of dollars in value in the DeFi ecosystem. So, I hope I got the pitch across there quite well. It's a big undertaking to go for, but Radix has started from the get-go on stepping back and asking the core engineers as well as the users of these platforms, such as Ethereum, what problems they ran into. And I want to go ahead and jump into this first analogy that I think Pierce really nailed in the recent presentation. That I think by the end of this, you guys will probably be feeling what Pierce said at the end of the presentation. It was coming up on almost an hour for the presentation where Pierce said, "You're still early, but not for long." And I think that this really hit home for me personally because I've been tracking Radix for a long time. I've known Pierce since 2018, but I've known Radix's kind of re-ambition on DeFi since as far back as 2019 and 2020. Now I want to go ahead and talk about this first analogy here of the game engine. Now Pierce focuses in on Doom, which is one of the first-person shooter games in the entire gaming industry. It revolutionized the way we thought about digital media. And one thing he focused on is that as someone like myself who's been a gamer for a long period of time, I understand how complex games have gotten over time and just how fast we've been able to ship out incredibly complex and beautiful game titles that we can end up spending chunks of our lives in, and also billions of dollars in, where there's been lots of value created. One of the biggest problems back in the day when it came to building games, similar to building decentralized applications today, is that it took so long to be able to build a certain game or a certain type of content. And the reason why was not so much the content itself, but the engine that fueled that content, to have to build rendering engines for lighting, to have to be able to build terrain editing tools, various things for character modeling and animation, all the things that make up those experiences, even maybe 3D rendered movies that you might have seen or animations, all of that took much more time to build than the actual content itself. And that's sort of like what we're experiencing today when it comes to Ethereum. Because if you use the same analogy here, essentially, we know that it takes a lot of time, not so much to develop applications within the Ethereum ecosystem. It does take some decent amount of time to build these dApps and program them in Solidity, but 80% or more of the time, possibly even up to 90%, is utilized auditing and reviewing code, hoping that one of those lines in your code that will be final and deployed onto the blockchain is not exploitable, is not allowing users on the network or hackers to be able to exploit and withdraw funds from the protocol that aren't theirs, to be able to do something malicious that would break the protocol in some way. And this is a big, big setback right now. Most developers are not spending time developing code, they are spending time auditing it. And if one line or a segment of that code is faulty, that already puts the protocol that you've built, that decentralized application, at risk and potentially billions of dollars worth of funds. What Pierce emphasizes here is the idea that we can build an engine to scale DeFi long term, not just on the core protocol level in the sense of offering scalability and being able to satisfy any kind of applications being built, but more importantly, allowing developers to radically speed up that process and be able to scale out applications that do much more than simply allowing you to swap from token A to token B or earning interest. Now, we've already started to see some of those traditional DeFi applications being built within the Radix ecosystem with the current developer partners or ecosystem partners that are out there, which is really exciting. But again, I recommend going through and watching this video if you guys are interested to hear more about this analogy Pierce talked about. But I want to go ahead and again emphasize that his analogy here was focused on the idea that you could start to build applications similar to the gaming engines that have been built today, like Unity or Unreal Engine, that have now sped up that process. So you don't have to worry about a lot of the heavy lifting and you can just start building. I can say I can relate wholly to this because before I got into crypto years back, one of my first careers that I wanted to get into was in level design and video game development. And engines like Unreal and Unity, which I've been messing around with for well over a decade now and been keeping an eye on, have just gotten better and better and have scaled up the time it really takes, or really lowered the amount of time it takes to build a functionable game application with increasing degrees of complexity and higher graphics fidelity. So again, I definitely recommend you watch the video. I think Pierce does it much better justice than I do here. But hopefully this sparks your interest in checking out the segment where Pierce really starts off that conversation. Because the next thing I want to focus on are the comments and discussion points from Matthew Hines. Now, Matthew Hines is the Chief Product Officer at Radix. He's been with the team for some time, and I recently also got to do a Twitter space where we had Matthew Hines chatting about some of these things more in detail. We had a lot of people come up to the Twitter space. I think in total 344 people tuned in. Some people from the Radix ecosystem, from DataDash. Generally speaking, though, he talked about 5 major key components. These key components are smart accounts, personas, Radix Connect, native assets, and transaction manifest. Now, I don't want to spend so much time going into the nitty-gritty details here. Matthew does a great job of that within the video, but I want to talk about what these 5 things are on the surface level and why it makes Radix a much better protocol, not only from a developer experience, but also mainly from a user experience. This is why we're talking about the user experience, or UX. So let's go ahead and talk about these one by one. I want to start here by talking about, in this case, smart accounts. Now, this is something that hits home a little bit personal for me because, as many of you might have known, we used to have a crypto wallet here on the channel that I created called Digifox. And one of the big things we focused on was having essentially an easier means of recovery. Now, smart accounts are essentially focused on allowing you to create cryptocurrency accounts that don't require seed phrases. We utilized something similar to this in the Ethereum protocol with our Ethereum wallet. And this was such a radically transformative technology, which was originally kind of pioneered by a couple wallets like Dharma and Argent. But the problem with deploying this kind of technology on Ethereum is it's not incredibly easy and robust. You have to use relayers, you have to use third-party service providers, all these different tools to make something like this happen. Whereas Radix is now allowing you to generate wallets without seed phrases and utilize what's known as smart recovery or utilize guardians. So I'll give an example here just to put it simple. Let's say, for example, you've got a crypto account you want to set up where you store Radix, your stable coins, everything that you can think about. And I wanted to have you, the viewer, as one of my guardians, essentially, my recovery agents. And maybe my dad, and maybe I want to have a third-party service provider that will allow me to do email recovery. You can really take it however you want. You can have one guardian, you can have 100 guardians. Simply put, I would turn to you when I need to do my wallet recovery. And so long as you sign off that this is Nick trying to attempt a recovery, then from there on out, the recovery can be initiated and I can get back access to my account, even if I lose my phone or I lose my desktop computer. This is a major transformation in the user experience and gets rid of one of the biggest friction points, which is just seed phrase. Every time you have to download a self-custodial wallet, fortunately, you got to write down one of those 12 to 24-word seed phrases, and if you lose those 12 to 24 words, which I think is much more likely than losing your phone, ironically enough, then you've lost all your funds. Plain and simple, and that's not a great user experience and is a big friction point. Now, outside of that as well, you've also got personas, which have a lot to do with how you actually demonstrate yourself within the Radix ecosystem. So again, I don't want to spend too much time with that. I think personas are quite simple, and again, it kind of gives us much more of a feeling to the traditional login experience and what we're used to in a Web 2 environment, which I think is essential rather than pretty much identifying yourself with some random hashed address on the Ethereum network or any other type of EVM compatible chain. That's not a very good user experience. We should have unique identities that can have multiple accounts within them. That's a big factor within the personas feature within Radix. But there's another third big one here as well, and that's Radix Connect. Now, within this presentation, Matthew Hines brings up a very good point here, which is that right now, there's not many good ways to be able to connect with what you do, say, on your mobile device and the dApps and interactions you have on your desktop. Radix Connect allows you from a protocol level to be able to have an interlocked connection between your wallet on your mobile phone as well as the interactions and your wallets on your desktop. Most of the applications we do are tended to be on desktop. It tends to be that because we need more user interface, we need more room or real estate to be able to do those interactions, and our phone can serve as the authenticator to be able to verify those transactions. Now, there are two other really big things here that I think start to play into Radix being very big, and that is, of course, the native assets as well as transaction manifest. Now, to give you guys the very quick pitch on these real quick, and I'm going to go ahead and reference some blogs that you guys can turn to that will maybe help to visualize this or maybe dive into some unique videos going into some of the nitty-gritty details. Essentially speaking, native assets and transaction manifest completely upend the horrendous traditional user experience you have utilizing wallets like MetaMask. Now, if any of you have done a swap on Uniswap or have deposited funds into Compound or utilized countless other DeFi protocols out there in the space, or maybe signed a purchase on OpenSea for an NFT, you will know how terrible the user experience is when it comes to committing that final signature, okay? And also knowing how assets look within a wallet. So I'll give an example. If you provide liquidity into Uniswap, you'll get LP tokens, liquidity provision tokens that prove as an IOU you can claim tokens you've provided to Uniswap and withdraw them eventually. And you're also entitled to the earnings from those LP tokens. But when you look at it with inside MetaMask, as Matthew covered within the video, the user experience is really poor. It's not very clean whatsoever. And you don't really know on top of that as well, when you were originally maybe providing that liquidity, what you're doing. The message that MetaMask gives you is quite abstract. It looks like a mixture of hexadecimals. And essentially speaking, the reason why this is because MetaMask, while it is an industry-leading wallet, it doesn't know all the information that it needs to present to you the proper message in plain, simple English. And the reason is because there are core limitations in the way that Ethereum is built. There is data that it has to request from these smart contracts to be able to get that information. And unfortunately, it doesn't always have that information. And what makes matters worse on top of that, in regards to native assets, again, we don't know always what assets we're interacting with or the details about those tokens. What's the supply of those tokens? What features or utilities can come with those tokens? And that's, again, one of the big things that comes here that was, again, revealed here at RadFi, that essentially goes through and talks about providing details to those tokens. Transaction manifest. Transaction manifest is probably one of the biggest things that Radix offers. And essentially speaking, this allows you to know exactly what you're doing when you're signing a transaction. In plain English, I'm going to be sending Bob 500 tokens of EXRD or XRD. I'm doing a swap between Bitcoin or wrapped Bitcoin to wrapped Tesla shares on the Radix network. Very simple, plain English transactions that really start to give us a clear idea about what we're doing with our funds. Now, if this isn't interesting enough for you guys, I definitely recommend you check out not only the recent blog post that they put out on December 9th, where they've got a lot of really interesting small videos that dive into some of the niche topics around the Radix wallet, crypto, intuitive web development, but on top of that as well, just check out the core video itself. I highly recommend you guys give Pierce and Matthew some time out of your day. Listen to it while you're, again, maybe doing some things around the house or you're at work. I highly recommend it because this was one of the most exciting presentations. You guys know we've been generally pretty negative here on the channel here as we're just looking at the market sentiment right now. The market is not looking very good. But the key thing is to focus on the projects that are building during the bear market. And as we talked about in today's video earlier on, looking for the companies that are aiming to do things radically different, similar to how Amazon did with e-commerce, completely reshaping the way we thought about retail. Similar to the analogy that Pierce made about the game engines like Unity and Unreal Engine that make up the vast majority of new titles out there on the market. This is the kind of transformative technology and rethinking of how we do blockchain, crypto, and DeFi, as well as NFTs, that is going to reshape the industry. And no matter if it's Radix or another protocol out there, this is the kind of focus we should have right now, and the kind of projects that are aiming to completely rethink the industry. So, if you guys are as excited about Radix as I am, consider dropping a like. If you haven't already, consider subscribing, join the channel. We always like to cover the most exciting protocols and updates in the space here on the DataDash channel. But until the next video, everyone, I'll see you all in the next one. Take care, everyone.